This cycle has been super fast, and the amount of CapEx that's been deployed is mind-boggling. And unfortunately, there's a lot of circular financing going on. And this has been highlighted by analysts that have done the deep dive, and they've shown that NVIDIA is selling to OpenAI, and OpenAI is selling to Microsoft. So there's all this circular financing, and there's no cash flow. So there's earnings being generated by these hyperscalers, but not cash flow. And so this is a problem. And the credit markets are starting to show duress in the AI space. Investors are demanding higher yields now because of the suspicion that the ROI isn't there. And Google recently issued an equity offering, 40 billion of which is going to go to data center spend. And they probably did that because financing it through equity is cheaper than debt. So that's telling you something. The debt markets are calling a timeout, and that'll eventually slow CapEx and pause it, which will cause all these tremendous moves in these semiconductor stocks and NVIDIA to take a hit, and they will. We're IPOing SpaceX, Anthropic, and OpenAI. Tremendous amount of supply coming onto the market. That has to come from somewhere. That's going to come from other asset classes, other stocks will have to get sold in preparation for buying these IPOs. Secondly, the Mag 7, which have been our tremendous free cash flow generators, have been buying back their stock, which gives a bid to the underlying issue that is their stock. Because of their free cash flow is going the wrong way because of this build out in CapEx, they're going to pause on stock buyback. So you have new supply coming on and a former bid in the market going away. So that's just without regards to fundamentals. So the supply demand configuration is going to flip on the margin. Now, if the fundamentals get bad, it only makes it worse. The other thing that's super interesting is people who are generating all this need for CapEx, the two big ones, OpenAI and Anthropic, are not public. So we don't know what their numbers look like. And I think there's games going on behind the scenes to make their numbers look temporarily good. But think about this. In the dot-com phase, all the companies that were generating the CapEx, the telecom companies and these speculative telecom companies were public. So you could see what was going on. And this time, two of the largest buyers and generators of this CapEx, we don't know what's going on behind the scenes. And what was interesting, I noticed in the fall of last year, there was this panic from Sam Altman. And that was when the private credit market started to wobble and financing became a little more difficult. And they floated the idea, and their fear was, we need government financing to continue. So they were basically pre-IPO, supposedly growing gangbusters, needed help from the government on financing. That should give everyone pause. Now, they floated the idea. It didn't sell well. They kind of pulled back, but they kind of their hand. The underlying credit markets are starting to sniff out the ROI may be suspect. And on the margin, debt financing is getting more expensive for these guys. And one of the heads of PIMCO, one of the biggest bond investors in the world, said, be careful on some of this AI debt. So there's already people that are professionals looking at this debt saying, be cautious. They're having a problem keeping their people employed. And their biggest fear is their own people. And I remember this when I was at BlackRock in the early 2000s. Our energy folks would go to China and talk to the bigwigs in China because they wanted to get a handle on the commodity boom that was happening then. The Chinese officials told them our biggest fear is our own people. So their plan is to keep everybody working all the time. There is now an employment problem in China, and a lot of the incremental laborers would go into construction. That's now struggling. So there's a lot of people who are now not making money, and that's an internal problem. And that's an internal consumption problem. And now we have trade wars because, this real estate problem started in 21, 22. They pivoted to exporting. They ramped up their export machine. So you can see their internal economy was declining, but they ramped up export. That's how they kept the lights on. And now we have trade wars and tariffs, and that's starting to impact them. And now their overall construction industry going under. What that means is this. There's going to be contagion to Japan. People don't know this, but both imports and exports, Japan is the largest trading partner of China, and South Korea is another big one. So we're going to have an Asian contagion problem, and this will spread throughout the globe, and it'll have an impact on all sorts of businesses and credit issues. China is going through deflation. They tried to export their way out of exporting their deflation to the world. Trump's put a stop to that, and now they have an internal problem. And the faster it goes, and we think we're in the acute phase, it'll have spillover to the global regions. And then an oil price shock only makes that worse. So, I know, and sometimes, know doesn't mean you're going to make money in the market right away. Knowing what I know, I look at the equity markets in the US and I go, boy, they're not discounting anything, any problems. If you look at industrial stocks, they're not doing that well. I mean, AI. Part of the reason why AI bubble has blown so big, if you look at the rest of the S&P 500, it's not doing that well. The bank ETF XLF, I think it did a death cross about 2 months ago, and the banks are not going to new highs. Industrials are not going. And so there's a lot of sectors that are still struggling, especially anything consumer facing in the US is not doing well. So the whole shebang is the last gasp acceleration of the AI bubble. And it's kind of perverse. Every money manager has to chase what's working at the end. I saw this in '07. I saw this in 2000. To outperform, you need ever bigger weights of these stocks, and you need to be more overweight than your peer. So it kind of feeds on itself until it's done. And then it's a devastating disaster on the other side. I'll give you an example. Janus was this growth stock mutual fund company. It had tremendous growth. They were in all the winners for the 90s. Then they became too long to be wrong, meaning their assets had grown so big, they thought it would never end. And then when the tech bubble burst, they lost a tremendous amount of money. And I remember being around those guys, and they'd been right for so long, they couldn't see the fundamentals getting worse before them, and they didn't understand valuation in history. So a lot of those guys rode some of those stocks down quite a bit. Nokia was one of the biggest stocks in the Janus, where's Nokia today? IBM had a 30% move based on a recirculated video of Trump saying buy IBM in December. Someone recirculated it on X. It went viral, and people thought it was new and bought IBM. This is where we are. And then the other thing that people should be alarmed about, again, when you get these moves, this is what I saw during the dot-com bubble, these types of announcements and then, in stocks. My friend was telling me yesterday, there was a ticker SPAC. People thought it was SpaceX, and it got bid up so this is what's going on. If I'm right, and I think eventually I'll be proven right, in 2 years, people will be so miserable and scared, and that's the time to redeploy some of your dry powder. And it's going to look really bad and awful, but that's when generational money is made. And that's why Warren Buffett's 40% cash, because he's going to be doing the same thing. And then in the rubble of the downturn, I would look for opportunities. I mean, the new AI technology companies that figure out, AI, large language models become commodities, and then there'll be companies that take advantage of that, niche companies that could turn into big companies. Just much like Facebook didn't create the backbone of the internet, but Facebook figured out a way to monetize it. So there's a lot of hope in the rubble. And then by 2030, I think there'll be a lot of productivity from AI. I'm not a doomer that robots and AI are going to displace all humans. If that's the case, government leaders have a problem on their hands. So I'm looking forward to what comes out after this downturn, which has to happen. I mean, they're so big, and there's the Biden administration kind of the economy with 20 million illegal aliens and, gave $500 billion to these people. And that was fraud that's going to work its way through the system. So I'm very optimistic once we get the correction. And, that's why doomer. I'm a big believer in cycles. And out of the downturn comes the next cycle. And if you're ready and prepared and have a good mindset, you'll be fine. That's kind of what I tell people. I was like, don't be in fear. Look, it crash and stocks go down 50% in 2 months, start buying. I mean, just guys. But this is more like a dot-com downturn where it took 2 years for the equity markets to go down 50%. It just depends on the speed. And, the not yet. And one thing I want people to understand is I'm a student of the market, and markets don't crash from all-time highs. If there is a crash, and I'm not calling for one, you'll see it. There'll be a drawdown from an all-time high of, say, 15 to 20%, a counter trend rally. And then if that counter trend rally fails and goes below the low put in from the top, then you could potentially have a big crash situation. I think the powers that be won't allow a crash, but they can't prevent a deflationary bubble in equities from happening. So it might be like the 73, 74 market takes like a year, go down 50%. In our U.S. economic report, we don't call for a systemic crisis. You don't need to worry about your money. We don't think there's going to be a banking crisis. There'll be some bank issues. There'll be credit contraction. A lot of these private credit funds have tremendous losses, which aren't the banks, by the way. Very clever to put all the risk into alternative asset managers this time. That's where the risk is. That whole complex is down today, by the way. I think we have to watch what the Fed does, and we have to see what the stimulus looks like to make the call. And if you look at every intervention we had the dot-com bubble. They lowered rates quite a bit. They inflated the housing market. Then we had QE. Then we had COVID. That was crazy amount of money printing. So I'm a second derivative guy. So if they don't come in with bazookas blazing, we're going to have problems. So we're going to get inflation near term, deflation scare, then reinflation attempts. It's a roller coaster. We're on a roller coaster. I honestly miss Bitcoin and all the wealth that was generated from it. And I got nothing against Bitcoin. I think it's a real asset at this point. There are some theses going around that quantum computing is going to kill it, that AI is going to make it, so a lot of negative headwinds for Bitcoin at the moment. But Bitcoin mysteriously peaked in October of last year. And also, someone who follows global liquidity thinks global liquidity peaked last year. And Bitcoin has been often speculated to be an indication of global liquidity. When liquidity is good, Bitcoin does well. When it's bad, it has problems. So if Bitcoin is down due to global liquidity issues, that means the NASDAQ is going to follow at some point and catch up with Bitcoin.